Howdy there, folks. Welcome into today's video. Oh boy, we got a good one here today, folks. Tom Lee, one video only to react to. Tom Lee versus Warren Pies, who has a phenomenal name if you're in a very different industry. So looking forward to getting into this one, bull versus bear debate, kind of looking across the market, where stocks are headed and those sorts of things. So just want to jump straight into this one. I appreciate everybody joining me as always. Thanks so much for being here, folks. New all-time high subscribers. We bust through the record each and every day, and I appreciate y'all for being here, okay? Alrighty, let's get into this.
Contributor right here at Post 9, as well as Warren Pies, co-founder of 314 Research. Guys, great to see you both. Appreciate you joining in the home stretch of the week toward the weekend. Tom, I think I frame it as a debate because the numbers are definitely encouraging in that Goldilocks manner, not too hot, not too cold. You are seeing inflation move the right way. You are seeing the labor market soften up but not fall apart. On the other hand, none of it's inconsistent with either sticky inflation or we're headed toward some kind of an economic downturn. So where does that leave the market entering the new month?
Well, I think you've definitely described why investors are bifurcated. You know, there's folks who see hawkish things and bearish things, and they stay bearish into this September. And on the other hand, I do think there's a lot of evidence of the soft landing and that inflation's on a glide path much lower. And given how hesitant people have been and how much cash is on the sidelines, I think that resolves positively. But the reason I would sort of emphasize that view is I think companies have been really managing this exceptionally well. I mean, energy second quarter earnings were up 3.5% year over year. I mean, the earnings recession has ended, so we're in a profit recovery cycle as well.
No doubt about it. You've seen an upturn in the forward estimates for the S&P 500 earnings. Although part of the August story, when we got this shakeout.
And by the way, earnings season's over now. Just my recap on how I feel about earnings season. Personally, I felt earnings season was definitely better than feared. I felt like there was a lot of really impressive numbers in there. There were some disappointing numbers in there, certainly. But the companies that matter much more to the stock market, those companies had the most tremendous earnings. The companies that, you know, maybe are a little lower, like some retailers that are a little lower down the tier, had some disappointing earnings, but those ones just don't matter even remotely close to as much to the stock market as, let's say, an NVIDIA does, or a Meta, or an Amazon, right? Or some of these companies that came through with these huge beats that are massive weights to the stock market overall. And so, yeah, you know, I thought the earnings season we got through, and it was pretty decent. The crazy part is this was a long earnings season, man. It just seemed like it went forever until finally, you know, it kind of closed up last week. And now we got only about another, let's see, end of October, we'll start getting a lot of earnings again. End of October.
Got this 5 or 6% pullback. You definitely saw sentiment cool off. But part of it was a rate scare in the sense of long-term bond yields going up to levels which at least recently have been uncomfortable. Are we out of the woods on that front? What do you, how do you interpret the way the stock market has tried to digest that?
I think it's two ways. And again, this is where it's indecisive because what we're seeing is a bear steepener. Which is actually generally good for stocks because it's reflationary. But we know when, like today, yields popped. Yields were higher today on a soft jobs report. We know that hurts tech stocks. So I think markets are reflexively still reacting to higher rates, and rates are unpredictable. So I would have liked to have seen rates fall, long-term rates, but they're up today.
Sure. And Warren, in terms of not really just the rate story, but even the internals of the jobs report, the general...
If anybody else lives in Vegas, how about this weather? How about this weather? Like 76 degrees today. Oh my gosh, absolutely just gorgeous.
...of economic data, which has somewhat cooled off. What does that tell you in terms of where we might be going, what the market has seemed to price in from here?
Yeah, I mean, I think that at this point, it's clear to everybody that we're getting to the late cycle. So even just a few months ago, there was a kind of an open debate, where are we in the cycle? And at this point in time, we're starting to decelerate, and that's pretty clear. Obviously, we're creating fewer jobs. The revisions are getting worse. I mean, that's something you see around recessions or into slowdowns where you get negative revisions month over month. We've had that through the beginning part of this year. Something we look at is residential construction payrolls. Those continue to decline, and you're getting negative revisions there too. So all of these things point to a late cycle type of environment. And then, as Tom's alluding to, you kind of have to ask yourself, Are we going to end up with a soft landing or a hard landing? And that's a tough question to answer, because I think at this stage of the cycle, both of those outcomes feel the same. You start decelerating on the data, you start having a softening of the labor market, the very first signs of softening, and it can go either way. The odds historically are that we're going to end up in a hard landing. Soft landings are really rare. The bear steepener, I agree with Tom, we just had a bear steepener, but when you get a bear steepener out of an inverted yield curve, that's usually before you enter a recession. And the most important thing here is not predicting the right outcome. It's understanding what's priced into various markets. And I would argue that you're not being paid to bet on a soft landing anymore, that right now markets in general are already pricing that in. So if we get that outcome, you're gonna have to look ahead and say, okay, what's next?
So if you're betting Mr. Pies, okay, yeah, I agree with him. If you're betting on just the indexes in general, yes, you're not being paid a very attractive risk-reward profile right now, because you're basically kind of betting on the soft landing happening, right? And so, but there's a lot of stocks out there that are just heavily beaten down that I think you are getting that risk reward. The indexes in general, no. Many stocks a little further down the list outside of the most important ones, yes, you are getting paid. But he brings up a great point that usually if you're going to a soft landing or hard landing, you're usually in a situation where things are getting worse, but you're not really sure, like, how bad, much worse, how much are things going to decelerate. But there was an interesting phenomenon that went into this particular situation that we haven't had going into past recessions. One was you had going from a closed down economy into a full go open economy again that took, several years to kind of ramp that back up, right? The second component that you don't usually have right before a recession is just an insanity amount of stimulus pump and money pumped into the system, right? Which is obviously what we had certainly in 2020 and into 2021. And even into the beginning of 2022, and with exceptionally low rates. So that's where things get a lot more confusing. If you didn't have that, I think you could have already had this landing scenario. But then again, if you had that, right, or let's say you didn't have that, you didn't have all the stimulus pump, you didn't have the rates at zero, blah, blah, blah. Well, you wouldn't have ever had that insane inflation either. We wouldn't have. So you can always look at things differently. And so I think that's just a factor that we all got to keep in the back of our mind. If you were betting on, a great financial crisis situation, you didn't have the sort of money pumped into the system right before that we had, okay? And so these are things to definitely consider out there. You didn't have everybody locked in at 2 and 3% interest rates on their mortgages, right? These are things to consider.
I think that under a hard landing is actually...
Nor did you have the biggest infrastructure package ever passed by the government that's going through over the next several years, which is obviously a tremendous amount of spending out there from the federal side, right? All things to consider.
Kind of underpriced at this point in time. So, I think we all agree kind of on the lay of the land and the weakening of the data. It's just a matter of what's priced in the markets here.
Yeah, I agree with you that it is a bit of an eye of the beholder situation, because you can't fully extrapolate from here how the numbers are going to go. And interestingly, though, I've been with you on this idea. Look, it's hard to argue you're not late cycle when the unemployment rate's already 3.5% and the Fed has had this tightening campaign. They're just about the end of it. That kind of defines a later part of the cycle. On the other hand, you've had a retrenchment in manufacturing. You saw the ISM manufacturing pick up. Housing got blasted, but then maybe is showing maybe some signs of life, who knows? And then the corporate earnings cycle maybe also had a little bit of a dip and a comeback. So how does that play into this idea of how exactly to price this moment in the cycle?
It's a weird cycle. I mean, everyone has to have, there's a large forecast uncertainty at this point in time. I think that housing, just to take one point you brought up, housing, it's showing resilience, but I would argue it's not reaccelerating. And so there's been a bit of a confusion that the housing market's just kind of taking off from here. We're actually seeing prices soften. We're seeing starts continue to trend lower. I mean, single family starts went from over 100,000 a month down to 70,000 a month, and they're still and you're seeing job losses in that segment of the economy as well. So, to me, this is resilience. It's not reacceleration. And that's the key, is that we're in this cycle where fiscal spending has supported this cycle for a long time. It may continue to do that for a while, and where this long cycle is drawn out. But reacceleration, I think that the PMI data has gotten screwed up this cycle already. So I'm not going to I'm putting that in the penalty box. Mm-hmm. As far as earnings go, It's priced in. At this point in time, you have double-digit earnings growth for 24, double-digit earnings growth for 25, margin expansion for both years. That's optimistic. What happens if we undershoot that, if the hard landing scenario starts to get repriced? And then you usually go to bonds in this scenario, and that's been a big problem for stocks. But usually at a Fed pause, bonds are trading basically right in line with the Fed funds rate. And at this point in time, you're seeing that, and this is the 10-year. The 10-year is right now like 125 basis points below the Fed funds rate. So bonds are already priced for the cut cycle. So across the assets.
So I think an important thing to think about in regards to the market is the market's always looking 6 to 12 months. I always call it the baby scenario. They're really looking like 9 months out on average, right? Some are looking more toward 6, some are looking more toward 12. And I'm talking about the big players in general in the market, right? Hedge funds and those sorts of folks that really control a ton of money. So let's look at it from their standpoint. Let's think about the next 9 months, right? I think there's I don't think there's many people worried about the remainder of this year. So let's just call it the next 4 months, okay? So you take that out. Then you say, well, what about right after, once we get in the new year? Yeah, there's a potential that things could weaken there, right? Definitely a potential there. But I don't think a lot of the big money folks are necessarily convinced that, oh yeah, everything's going to tank at the beginning of next year. So then that takes you all the way out to the second half. But I don't think anybody really has a clear judgment on what's going to happen in the second half of 2024 right now. Everybody's just kind of thinking about the end of this year and into the beginning of next year. And I just don't think big money is convinced we're going to have a massive recession in the next 6 to 9 months. So that's where big money's kind of focused, and they're looking and they're saying, well, at the end of the day, we can't just price in a hard landing scenario, a big recession, because we don't know if that's for sure what's going to play out, right? Then also you take into account that, okay, let's say that we have that. Where do you think rates are going? Where do you think the Fed funds rate is going? Of course, it's going back down to zero. If you have a hard landing, they're going back down to zero. And they'll do it in a snap of a flip and flapjack and fingers, as we know. It doesn't matter what inflation's at, because, by the way, if you have a hard landing, we're going into deflation. And it's just a question of how bad's the deflation. Look what happened in the Great Financial Crisis. So in a hard landing scenario, okay, you're back at rates at zero again. You're back to quantitative easing, and you're back to money printing and a fun next 5 years. So that's where you get into this whole scenario, and the market starts to look out, and they're like, okay, so hard landing, we get rates back at zero, quantitative easing for years. It's not going to be a day. It's going to be years. It's not going to be a month. It's going to be years of quantitative easing if you have a true hard landing. Think about that for a moment. Years of quantitative easing, years of money printing. Let that sink in for a moment, okay? And then you back that up and you say, okay, if we don't have that, well, economy keeps chugging along. Earnings are good. Everything's good. What you got? What you got, okay? That's where, you have to be very selective in kind of the way you're positioning in the market. And you have to be very selective with kind of where your asset allocation is. But you can look at these things from multiple different sides. And I guarantee you that's how big money looks at these things. I've been doing this for 15 years. I know how these people think, man. Listen to them talk all the flip and flapjack in time, 15 years. And that's exactly where their mind goes. They're like, hard landing, quantitative easing for years, soft landing, okay. Everything's good and grand, and we continue to roar this market higher.
Everything's priced for this soft landing and Fed cutting rates.
What would you say to that, Tom? I mean, you do have an S&P 500 at, 18, 19 times forward earnings. Certainly not out of the realm, but not cheap. And, the idea that this is a little bit of a disjointed cycle, it's hard to handicap.
I heard all Warren's points. Typically, though, a recession is a sudden change in business conditions because of leverage or a commodity shock. We've had those shocks already. We had 2 quarters of negative GDP last year. Businesses.
Damn, that's a good freaking point, Tom Lee. That's a freaking really good point.
Conditions because of leverage or a commodity shock. We've had those shocks.
That's exactly what happened in 08. Oh, that's so freaking good. And yes, he's right. We already had that. We already had the commodity shock of, I don't want to say of our lifetimes, but we had the commodity shock of the past 20, 30, 40, 50 years. I mean, that was insane. You had commodities that from where they were at, in the first half of 2020 to where they were at by the first half of 2022. I mean, we had commodity after commodity up 100%, 200%, 300%. That's not normal. You don't just see commodities go up hundreds of percent in a 2-year span. It happened. It happened. Okay? And so that's just a freaking great point. And you go back to '08, we had an oil shock specifically in that sort of scenario where oil prices just went to the moon, right when you were basically going into recession. It was a very ugly, ugly situation. So, man, that's such a good point by Tom Lee. Well freaking done.
Already, we had 2 quarters of negative GDP last year. Businesses aren't over-levered and households are not over-levered. In fact, next year, if the Fed pauses, mortgage rates could drop, which is a huge...
100%. And as of right now, the consumer is far, far less leveraged than any point pretty much in history in terms of their leverage ratio versus their income. It's incredible. Everybody wants to look at the total dollar amount. Tell me you don't know anything about economics. Tell me you don't know anything about macroeconomics. If all you look at is the total number, of course the total number is going to get bigger over time. Like everything gets bigger over time. The economy gets bigger over time. Like debt levels get bigger over time. Asset levels get bigger over time. Everything gets bigger. It's all about percentage. How much of a percentage is your debt? If Warren Buffett has $2 million in debt, sounds insane to the average person. Oh my gosh, Warren Buffett's so heavily in debt. He's $2 million. I can't even imagine having $2 million. Never mind $2 million in debt. Oh, did you ever take into account that he's got like $100 billion of assets? Did we ever take that into account? Total numbers mean nothing. It's about the percentage, folks. Percentage. Keep that in mind, okay? Just a little gem for you there. Percentage basis. And the facts are the consumer's not even remotely close to as leveraged as a percentage basis as they were in, let's say, like before the great financial crisis. Not even the same ballpark.
Of household financial conditions. And when it comes to valuations, X the FANGs, the market's really at 16 times, which is not demanding. And typically early in a cycle, you get huge multiple expansion. We haven't had that yet. So I would say it's undecided, but I think a soft landing, stocks have 20% upside, still sort of valid view.
I did mention that, even today, of course, you see outperformance by small caps, some cyclicals, the bank stocks. So on a given day, you do start to see traction, and the cyclicals did not really give way even in the August downturn on a relative basis. Do you think the Fed is done, Tom? I mean, is this it?
Yes, that's one of the things we're watching for this month. I think when we get August CPI, I think the Fed probabilities for both the September and November hike drop to 0. And it's 7% and 35%. So there's still a huge way to go. And I think that's going to change positioning in fixed income, and it's going to boost equities as well.
What about the idea that historically the first rate cut isn't necessarily a bullish sign? I mean, I know there's exceptions to that.
Yes. But, as we all know, like this hasn't even been typical cycle because normally stocks rise into the first few hikes and they fell 27%.
Yeah, even before the first one.
Well.
Yeah, exactly. Warren, you mentioned that it's tricky to maybe...
Great points by Tom Lee. Great points.
Head for bonds in this scenario, even if you think the economy has some risk to it. But you do prefer commodities. What's the rationale there?
Well, this is the late cycle playbook, and as Tom talked about, at the end of these cycles, you usually end up with some kind of commodity shock, and that's specific to oil. I mean, that's the largest weight within any commodity index. And right now we have the Saudis basically driving prices higher with a massive unilateral cut. And at the end of the day, demand has not fallen off a cliff in the United States. It's not going to. I think there's still strong underlying demand. Late cycle doesn't equal recession. And China's on its counter-cyclical path to the United States, and they're...
See, I have such a different view than this gentleman, Mr. Pies here, okay? Mr. Pies believes commodities are more attractive versus stocks and bonds, right? I look at that and I say, how? If you're worried about a medium landing, a hard landing, do you think commodities are going to do well in that? No, of course not. If everybody starts to be scared that, hard landing is coming, I can tell you, oil is not going to be the place to be. That's not how this works. The price goes down substantially in that sort of situation, right? The more you have actual recession concerns, the more you can see weakness in oil price overall, right? If the U.S. was to go in recession, that's not going to be good for China. I can tell you that much, right? And if Chinese economies hurt even more, it's not going to be good for oil prices, okay? That's something very important to keep in mind.
Digging out of zero COVID still. So I think the backdrop is positive for oil prices and commodities here for a little bit longer. And so that's our favorite spot. I would agree with Tom on one other thing, is that I I think the Fed is done here. And I think that the first few weeks of September into that Fed meeting could be a little bit of this relief rally. But I look for the Fed to raise that.
It's always a potential. It's always a potential. Is it super realistic? I don't know about that, because usually, especially when you're kind of going into winter, usually you see oil kind of, if anything, retrace and kind of go backwards. So I think that's actually a really bold prediction Mr. Pies is making here about $100. I think the only way you get there is if everybody's convinced there's no hard landing coming. If everybody jumps on the bandwagon of no hard landings coming, soft landing, then it's a possibility. But even in that scenario, it's still going to be a challenge, because just usually you don't see a massive bull cycle into wintertime for oil prices.
Terminal rate. And that to me is the last lever that they pull in this cycle, is they start trying to boost terminal rates. That's where the Fed funds rate ends up at the end of this cycle. The last time they did that was 2018. It was a lot of indigestion for asset markets, bonds, and stocks. So that's something I'm watching.
Yeah, I guess that is the question, Tom, because there has been this case, well, the stock market's banking on rate cuts because they were priced in the forward curve. We keep pushing that out when the rate cuts are priced in. Is a bullish case contingent on relief on the Fed funds rate within sight?
I think it's going to be important, Michael, because next year, let's say inflation, the run rate is down to 3.
What are the frat bullies doing down there on the Wall Street trading floor? Like, come on, guys, give it a break.
And the Fed funds is 5.5. That's a massive, real tightening of financial conditions. So that could, as Warren says, that could tip us easily into a recession. So I think if the Fed is trying to avoid huge job losses and not so worried about what equity prices are doing, I think they'd be cutting next year.
Yeah, I mean, that is the question. I mean, clearly that's why the inflation numbers need to move in their direction for them to have some kind of flexibility on that front. Final point, Tom, you mentioned that, it is the FANG complex that is magnifying the valuation of the overall index. Does that mean avoid that area, or are they operating on just like a different energy source?
It's a great question. I used to do wireless, and so I was a tech analyst for 15 years. You should never sell a tech stock on valuation. So for the FANGs, as long as they have visibility and positive revisions, their multiples can go up far more than most people would like to see. So it could get very uncomfortable.
Yeah, it's true if it does continue like this. All right, Tom Warren, I appreciate it.
So,
great conversation.
Interesting point here by
again.
Tom Lee saying you should never sell a tech stock based upon valuation. Yeah, and you should usually never short a tech stock based upon valuation either. Because at the end of the day, I mean, great tech stocks, they always looked overvalued. Like Amazon's looked overvalued for 20 plus years now. 20 plus years. Unless you really are down the rabbit hole and you really understand where Amazon's going long term, you've looked at that stock for 20 plus years and said, I can't own this stock, it looks overvalued. Tesla's looked overvalued since the day the company went public, right? But you take a step deeper if you really understand the business and you're like, oh man, this has this incredible opportunity, right? So yeah, that's actually a pretty interesting point he makes there at the end. And in regards to the economy, hard landing, soft landing, medium landing, any of that, we're not going to get clarity on that here in the short term. That's something that just needs to play out. Like, people have wanted to just get either get it out of the way or just get clarity on that. We're not going to have it right now. We're about to go into year end. We're obviously about to go into holiday shopping season and all that. Unemployment rate's very low right now. So you're not going to get any clarity really in the short term about that side. I think you're going to get a lot more clarity on if we're having a soft or hard landing, medium landing, whatever in 24, but you're not going to get that in the short term. And so that's why I just look at this market and you have to be very disciplined with what you're making moves with, right? I'm buying stocks every week. I'm also cashing every single week. And I'm also adding hedges every month for 2024 because there's several different scenarios that can play out here. And I've got to be ready for whatever plays out in 24, whether it's everything just continues to be great, everything gets better, or it's a situation where things get bad. You got to be planning for all those scenarios in 24, in my personal opinion. I appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. We got a free workshop for you guys. There'll be pinned comment down there. That's how I find 10x stocks workshop. That's absolutely free to access that. That will be pinned comment. Much love and have a great day.